Asset liability management, often abbreviated as ALM, is a strategic management process that financial institutions use to manage the risks arising from the mismatch between their assets and liabilities. ALM sits between risk management and strategic planning. This process is particularly crucial for banks, insurance companies, pension funds, and other financial institutions. The primary goal of ALM is to ensure that the organization's assets and liabilities are aligned in a way that minimizes risk and maximizes profitability. Investopedia describes ALM as asset/liability management, is a process of managing the use of assets and cash flows to reduce the firm's risk of loss from not paying a liability on time. Well-managed assets and liabilities increase business profits. The asset/liability management process is typically applied to bank loan portfolios and pension plans. It also involves the economic value of equity. Key concepts for ALM involve 1. Assets. These are the financial resources owned by the institution. Assets can include loans, investments, cash, and other holdings. 2. Liabilities. These are the financial obligations or debts that the institution owes to external parties. Liabilities can include deposits, loans from other institutions, and bonds issued. 3. Asset-liability mismatch. Financial institutions face various risks due to differences in the timing, interest rates, and cash flows of their assets and liabilities. An asset-liability mismatch occurs when the maturity, interest rate, or other characteristics of assets and liabilities do not align. Who uses ALM? Asset liability management is being used by various types of organizations like banks, financial institutions, non-bank finance companies, insurance companies, asset management companies, and even non-financial companies, either for regulatory or prudential requirements. Risks managed through ALM process. Though balance sheet management and profitability management are the key focus areas of ALM, it also includes optimizing returns, hedging risks, smoothing the margins, and the like. ALM involves various risk management techniques to identify, measure, monitor, and control the risks associated with asset and liability positions. This includes stress testing, scenario analysis, and using various financial instruments to hedge risks. In particular, the risks managed through ALM process are 1. Interest rate risk. One of the significant risks managed through ALM is interest rate risk. Interest rates can affect the income and expenses of financial institutions. For example, if a bank has more long-term fixed-rate loans than fixed-rate deposits, it might face challenges if interest rates rise. 2. Liquidity risk. ALM also addresses liquidity risk, which is the risk of not being able to meet short-term obligations due to a lack of liquid assets. Financial institutions need to ensure they have sufficient liquidity to cover withdrawals or unexpected demands. 3. Currency risk. ALM involves matching the maturities and cash flows of assets and liabilities. By matching the currency denomination of assets with that of liabilities, financial institutions can reduce the impact of currency fluctuations on their overall financial position. ALM strategies often involve diversifying the currency exposure of assets and liabilities. This can be done by investing in a variety of currencies and spreading the currency risk across different markets. Diversification helps in reducing the impact of adverse currency movements on the overall portfolio. Financial institutions can use various hedging instruments to manage currency risk. For example, they may use currency forwards, options, or futures contracts to hedge against potential losses due to adverse currency movements. This helps in protecting the institution from the impact of currency fluctuations on its financial position. 4. Capital markets risk. In capital markets, financial institutions use derivatives for dynamic hedging. ALM practitioners may employ interest rate swaps, options, or other derivative instruments to hedge against adverse movements in interest rates or other market variables. 5. Regulatory compliance. Financial institutions are often subject to regulatory requirements regarding capital adequacy and risk management. ALM helps ensure compliance with these regulations. 6. Profitability. While managing risks, ALM also considers optimizing the overall profitability of the institution. This involves making strategic decisions on asset allocation, interest rate strategies, and funding sources to maximize returns within an acceptable risk framework. This brings us to the end of the topic. Thank you for watching.